All right. Perfect. Well, thank you everybody for coming today. I really appreciate it. And what we're going to talk about today is how to audit proof your business so you beat the IRS. This is, by the way, been one of the most people have been really charged about this issue, so I understand it. So we definitely want to cover this. But let me give you a little bit about me in case you don't know who I am. My name's Adam. I've been doing this for over 22 years. I've worked with over about 100,000 returns, worked on hundreds of audits. So I feel like, I'm qualified to talk to you about this today. So yeah, there's a picture of the kids. Me and Maria. Okay, so here's the first thing that I'd like to talk about. And I've spoken to a couple of clients before doing this meeting, and they're like, are IRS agents really being trained with guns? Are IRS agents really going to come ransack my place? So I know there's a lot of fear on this. So I just want to say this presentation will be really no hype, no bullshit. A couple of things. The IRS is not hiring 87,000 agents. And unless you're running drugs or doing a lot of bad things, you don't have to worry about people with guns showing up to your place. So I do want to get that out of the way. So here is the really big idea, and this actually is true, is that somebody has to pay the bills. So what's happened is our federal deficit is give or take 30 trillion, which is on the books. And a lot of economists think you could double or triple that with all the money that's considered off the books. As many of you know, COVID printed a lot of money. Inflation is soaring, the recession is here. And really, somebody has to pay the bills. I know that's such an awkward thing when it comes to the government because they just continue to print so much money, but eventually we do have to pay our bills. So when it comes to paying bills, options to reduce the deficit. One option is to increase taxes on everybody. And this is not popular. No one likes that idea. Another idea is to overhaul the tax system. And that's kind of impossible because we have political deadlock. It's impossible. The last option, the easy button, is audit more rich people. That is the easy answer. When you talk about, let's say the people that earn the top earners between 1% to 5%, it's very easy to say, go after those guys. And that's what they've chosen to do in order to pay the bills. So let's talk about this Inflation Reduction Act, which is really empowering the IRS and how they're going to do it. There's been a lot of discussion about this issue. So I kind of want to simplify it, is that the IRS in total is going to get about $80 billion over 10 years. So that's $8 billion a year. However, not all of it is going for IRS enforcement. So if you imagine, like any business, the IRS has employees that do customer service. They have, people who do payroll, people that just collect mail. There's a lot of people that have nothing to do with the IRS audit function itself. That being said, the budget that they are going to give them is about $46 billion over 10 years. And this is double their current budget per year for enforcement. That's the key word, budget for enforcement. And so the true number that I think is kind of accurate is around 18,000 new agents. And I do want to specify, this is critical. IRS audit training it's not like you snap your fingers and you're an IRS agent. It takes time to get to be trained, like any business. So the IRS says on average, it takes about 2 to 3 years to train a person, and kind of 6 months for more simple. It's my opinion that the people that they're hiring are going to be the more educated CPA accountant types that are going to go after the more complex returns. And again, that takes about 2 to 3 years. So everything that we're seeing today, the funding that's happening today, we're not going to see the results of that for about 2 to 3 years, which gives us a window to get ready. And I've linked here some Forbes articles. I think Forbes is a neutral website, at least fact-wise. And I looked at both of those articles, and they're very, I thought, fairly balanced between the political agenda was not there. It was more just facts on this one. So I felt good about that one. So please check those out. One thing I do want to say, They're also giving $5 billion to upgrade their computer systems. The IRS is very sophisticated in terms of their data analytics. Like I know we talked about Google and Facebook. Well, they got a lot more data. And so that is a little scary that they're going to be able to, the computer systems that they currently have are from the 60s and the 70s. So they're going to modernize their system to present day and probably stuff we don't even know is available. So I do think that their ability to hone and target people is going to be pretty substantially awesome. Now here's Treasury Secretary Yellen. When they designed this act, it got a lot of people freaked out. So there's a couple of things that they said that I just wanted to go over. That it's not going to be used for people below 400,000. So yes, they are going to target people, but the idea is it's going to be below 400,000. The idea is at historical levels. You can read this, and here's the actual the link to their whole article. But I just want to highlight some of my issues with their statement. The audits in relationship to historical levels, the last 3 to 5 years are historically down compared to the last 60 years. So what is the point of reference? Is it the last 4 years or is it the last 60 years? The next idea is that they're not going to, the IRS will not target people under 400,000, which is interesting. On the business side, it's possible that you could have depreciation, you could have a lot of expenses that artificially lower you underneath the 400,000. So it's like, I do think that they're going to, that 400,000 level is very easy to pick on a W-2 level, but on a business level, if you're grossing, let's say your business is grossing a couple million, but your income is very low, I still think you're going to be part of that group that they're targeting. The next thing that they're talking about is high net worth individuals. And I know, but all of us feel we're broke. I know a lot of you on this call are like, man, geez, Adam, I'm not rich. High net worth individuals, according to the IRS on a global level, is anything you get beyond a couple $1 million is considered a high net worth individual, which is challenging because if you live in California and you have a home and you have a 401k, you're probably by definition already a high net worth individual, even though you don't have a lot of cash liquidity in the bank. So that means anybody who's living a middle class lifestyle is pretty much subject to this. The next one are pass-throughs. They're going to go after pass-throughs. And that is an area that if you have an LLC, an S Corp, C Corp, obviously it's not a direct pass-through, but it's kind of related, is they're going to be going after you. Now here's the shocker. This is this is Yellen's own words. An additional hour of auditing someone making over 5 million generates 4,500 of additional taxes collected. And on the more complicated audits, they're about 80 to 100 hours. So what they're saying is that for every hour an IRS auditor is working on your case, the goal is $4,500 an hour. That is the expectation. So that's a little scary. Like when they're auditing you, they're not doing it because they're trying to raise money. They're trying to cover the deficit. And their dollar amount that they want is $4,500 an hour on the higher end returns. And on the lower end returns, probably what we're all familiar with, we're probably talking about maybe close to about $1,500 to $2,000 an hour. That's their target revenue per hour on each audit. So that's a little scary. So here's something that a lot of people are always interested in. How does the IRS select people and why? So every time a return is done, it's given a score. And the score is based on likelihood that that you've underestimated your expenses. And a person called a classifier reviews your return. If your scores are out of line, the person will look at your return and they'll say, yeah, let's give this person a shot. Let's audit this person. And then they'll direct the audit in terms of specific line items. That's kind of how it works. And what I've done is, I don't know if you can see this. And by the way, I have very, very average data analytics, but what they do is they take, so this column right here, so it says 100,000 and 34, 34, 34. Oh, oops. This is a mock return I came up with. And then on the right-hand column is based upon averages. And then on the far right is your percentage compared, is how you compare to averages. And they look at standard deviations. How far do you deviate from the mean based upon your specific business, based upon your specific zip code. So if you're far from the mean, and things look weird, those are some things that they're looking for. But this is kind of how it looks on their end. So let's talk about some of the audit triggers. that the IRS looks for. First year issues. Obviously, if it's a first year business, they are going to expect a loss. But if you're having a first year issue and it's a huge loss, again, they know that first years there's a lot of potential fraud going on. There's also the issue of income thresholds. So the IRS has limited resources. So that means when they audit you, they're going to audit people to get the most money possible on a per hour basis. They're kind of like us as business owners. We want to earn the most per hour. So they're going to go not to base on the total amount of fraud possible, but how much can they collect? So for example, if you gross 100,000, how much can they get out of you? Versus if you're $1 million business, 10 million. I will say that once you cross, so one particular line is 100,000, the next line is about 1 million, then you get to 3 million, and then you get to 10 million. And once you get beyond 10 million, you're in a whole new category. And I think most of the people on this call are going to be in the 0 to 10 million. And that's called the small business unit. And I think that's where they're going to earn a lot of money. We'll talk about that. Some other things that trigger audits that are just so predictable is that if you have a lot of expenses and no income, that's an audit. That's a very triggering thing. If your W-3 doesn't match your payroll expense on your tax return, if your gross income doesn't match what they have as a 1099, that'll trigger audits for sure. Year-to-year losses, so if you have continual losses, that can be triggered. Amending returns is a real trigger. The last one, which is probably theoretically the most important one, is the IRS looks at as the ratio of your expense to your gross revenue. So your cost of goods sold to your revenue, your travel. So let's say your business makes 100, your gross is 100,000 and your travel is 30,000. That seems a little weird, especially if if you have a sandwich shop. Why would a sandwich shop owner have 30,000 in revenue, whereas a consultant might? So the IRS has tons of data. And so because they have so much data, they know on average how much income to the expense to income ratios are for different segments. And that's how they're able to hone in on people. So let's go to probably something that we're all very emotional about, is why will the IRS target wealthy people? And the short answer is wealthy people are already being audited. So wealthy people, like the people you see, they're already being audited every year. So you're not going to suck more money out of them because they've got the best accountants. They're working on a global scale. They renounce citizenships. They can go to Barbados. They can go to all of these crazy countries like Ireland and do stuff that you and I just can't afford to do. So will they go after the wealthy people? The answer is no. And when I mean wealthy people, I'm talking about high-level billionaires. They're already being audited. The next level is, now this is kind of interesting because in the new provision, there is a 15% minimum tax, but I don't think it'll be as impactful. But will the IRS start auditing more Fortune 500 companies? The answer is no, because they're already auditing them between the SEC and FINRA, and they're already highly audited. And they can do a lot of cool things that we as small business owners just can't do. Which leads us to kind of what I have is the Costco people like us. They're definitely going after us, and I'm going to explain why. And let me give you a little context. There's four types of audits. Four types of audits. A CP 2000 type of an audit. This is when your information on the return doesn't match what's been provided by or to the IRS. So this is in the form of 1099s. That's why that in the past years, the government's really like they want more 1099s issued, so that way things match up. Obviously, PayPal, Venmo are now doing 1099s, 1099Ks. So if those things aren't matching up, boom, that's called a CP 2000 audit. Those, by the way, those are 50-50 audits. Those are like, they're wrong about 50% of the time, and you can easily win 50% of the time. The next level are what called IRS letter correspondence. That's where the IRS will send you a letter, say, hey, send us receipts, and you basically mail back stuff. Well, you used to mail back stuff, then you started faxing stuff, and now they have a portal. But it's this idea that you work with a random IRS agent each time. This person, every time you send stuff, it's just there's a new person that looks at it. The next one that many of you have probably heard of or familiar with is called an office audit. That's where they send you a letter and you have to drive down to the IRS office and be in one of their interrogation rooms, or maybe what they call meeting rooms. Most of us are familiar with that. The last one is called a field audit, and that's when they come to you. And that's the one that most of us are terrified about, is when they come to our house and they come to our business and they come to our second home. And I will say that these are real. These do happen. And this is what I believe is where they're going to focus majority of their effort. And I'll tell you why. Let me tell you a little bit of background information on these types of auditors. I just think it's get a little profile. CP 2000 people, transitional people, people that do correspondent office audits, some college, people that do office audits, some of them do have college. The people that are field auditors, by and large, are CPAs, lawyers. These people are very intelligent. They're not stupid. They're very intelligent. And also, there's two types of IRS agents that I want to delineate. There's some people that join the IRS specifically to learn how they do what they do, and then they go into private practice. And their whole marketing pitch is, I used to be an IRS agent. I know how it works. Therefore, hire me because I can get you a better result. There's another type of person who's a lifer. And these are the people that are highly dedicated, inspiring in some ways because they deal with a lot of crap. And I just want to let you know that a lot of people truly do believe in the mission and purpose of the IRS. I just happen to believe in you more than a government agency. And I believe a lot of the people you on this call believe that your ability to spend money is greater than the government's. So in terms of process, because a lot of you guys are like, well, how does this audit work? So I want to go with the rounds, because I want you to know that different types of people have different types of mindsets, and different levels of IRS agents have different priorities. So the initial auditor, very letter of the law, they're looking to say no, and they have a manager you can always go to. Most things get settled at the appeals level. The initial auditor is trained to say no. They're like the ultimate mom figure. No. You might get some yeses. I should also say, it also depends on what kind of audit you have. A field auditor who's much more experienced is going to give you much more leeway, because they have the goal of making so much per hour. They're not here to bullshit. Like, these people are here to do business. So they're actually more lenient in some ways, and they're more unforgiving in other ways. Because if they think that things are likely to be true, they'll just settle right on the spot. So in some ways, while field audits are scarier, they're more lenient. But in terms of the audit process, you have your initial audit, you can appeal to an appeals officer. The appeals officer is a manager. If that doesn't work, you go to tax court, which goes back to appeals. And then you can go to pretrial counsel, and then negotiation hearings. I will say this is that as you go further down or further up, depending on your perspective, the people are much more lenient and they're much more deal makers, but you have to have a reasonable basis for what you're doing. Now, this is what I think scares all of us, is that if you have a C Corp, LLC, S Corp, those types of entities, they must be done by a field auditor. The reason why there's not so many field audits is there's just not enough field auditors. However, in this particular round, they're hiring specifically for these type of auditors, and most of us have these type of entities. So historically, we've been filing our tax returns and not being audited simply because there was no auditors to audit us. So the IRS knows this. They're like, shit, there's a huge population of taxpayers that have not been audited because we don't have trained professionals and we've been underfunded. This new bill changes that fundamentally. Also, the Trump law changes things fundamentally. Back in the old days, a lot of the auditors would focus on Schedule A items like unreimbursed expenses, medical expenses. But now that those are gone, they're taking people who used to be office auditors, turning them into field auditors, and now they're hiring more field auditors. So you're definitely in the crosshairs if you have one of these corporations. So let's talk about why this is such a gold mine. Again, historically, when you audit a small business owner grossing, let's say 7 million under, they know on a dollar per hour basis, they're killing it, they're crushing it. But they haven't been able to do it because the IRS has to work for the highest dollar per hour. So they've been auditing higher level businesses because that's where the most money they could get is. But now that they've got more bandwidth, they can come after us. These are very easy audits for IRS auditors. So let's talk about why. Oh, yes, these are the reasons why. Most of us have poor bookkeeping. We've got poor record keeping. We've got bad receipts. We've got poor logs. We've got bad promissory notes. We can, I think I'm pretty good, but there's people that are way better than even me. I'm pretty good, but not to the level that like a Fortune 500 person would have. Probably the biggest issue that all of us face is we have limited funds to pay for an accountant, lawyer to deal with these issues. So whereas a Fortune 500 company has a budget of millions of dollars, we don't. And probably the last one that most of you probably can relate to is our business life and our personal life. Like there's no separation, there's no boundaries. So if something personal is a business, it's like, well, it could be a little bit of both. If things get really murky and the IRS really just dives into that. So here is a list of things based upon IRS tax court issues. And I just wanted to highlight the biggest issue is substantiation. That means proving stuff. You and I lose cases because we do not have proof. Not because we were necessarily wrong, but we just kept such shitty records that it is what it is. That's why we lose. So, I love this. The glove don't fit, you got to quit. So when it comes, what I want to do right now is provide you some of the legal basis that the IRS is going to hammer you on. And when I think of lawyers, I just think of Johnny Cochran. What a guy, what a guy. Okay. So this literally comes from tax court opinions. This is literally text from there. So you and I, the taxpayers, have the burden of proof. That's the way it works. And we have to maintain records sufficient to prove what our expenses are. That's very clear. And by the way, I'll be giving out these notes to everybody. I'll be sharing this, so you'll have access to all this. In order to deduct something, it must be ordinary and necessary. And you have to be in the business, and you have to actually be in a real business. So ordinary and necessary, and be in a real business in order to deduct things. So this is what, in order to have a profit motive, right? So what does it mean to have a real business? You have to treat it like a business. You have to have advisors. What's your time and effort in this business? The expectation that your assets will make money. Those are the key ones right here. This is so incredibly important that I want to spend just a moment here. Is that this ordinary and necessary? Ordinary is something that is common or frequent for your business. And something that is necessary is considered something that is helpful. And so a lot of times IRS auditors will say, is that really necessary? Is it really ordinary? Did you really need to do that much? That's kind of the angle that they come up with. Now, in terms of proof, and boy, oh my God, proof is such an interesting concept. When it comes to proof, you need to substantiate the underlying claim and the amount. So you need to sustain the amount and the purpose. That's key. What is the purpose of that expense? And we'll get into receipts and all that kind of stuff later. There are some more stringent requirements for certain types of for expenses. So for example, anything to do with travel, meals, lodging, cars are things where there's a higher level bar. And guess what most of your expenses are, especially if you're a consultant, it's going to be those. And so the law is specifically written in such a way that the deductions you're most likely to have are way harder to prove. So this kind of goes into your books. Really good reading. I enjoy this stuff. Okay. So in terms of expenses, so again, this is where they're going to nail all of you. Is as a general concept, you have to have a business purpose, the amount of the expense, and your payment. That's kind of the high level idea. So a lot of clients are like, shit, Adam, I don't know what the hell you just said. What did you just say to me? Explain it to me like I'm Homer Simpson. So now we're going to kind of simplify this to make it kind of something that's, easy to grasp and understand. with the 800-pound gorilla, what a lot, and for a lot of us, who don't keep good records, is, and the IRS, they can smell this stuff so easily, is, are we making up numbers? That's what they're really looking for. That's the first level. When an IRS auditor first looks at your cases, are they making shit up? And are you writing off personal stuff, but pretending it's business? That's the first thing. That's the 800-pound gorilla. We're not even talking about proving legitimate expenses. This is their first thing is, are you making stuff up? And are you writing off personal stuff that's really business? And we could talk about this if you want to call me personally. Talk business and personal. It's like, like we're living in a society where like personal life and business life is one thing. There's no separation. So how do you demonstrate that? So here's kind of what I want to show with what all of you need to be doing. And I highly recommend this. Of all the slides, like Perry Marshall talks about, like 80-20 and 1%, has 99% of the value. This is probably one of the slides that has the most value compared to everything. Save all of your bank statements and credit card statements. That's a source of proof of payment. Okay. But in addition, so the IRS is getting hip now. Oh, they've learned about PayPal. They've learned about Venmo. They're learning about all of these different ways to pay for things. People are now paying stuff on cryptocurrencies. And the IRS is very aware of this. And these are areas that they're going after. So all of those statements. So anything that were income or expenses, anything where transactions are happening in and out of, save those, okay? And what we're going to do is we're going to create financial statements, an income statement, a balance sheet, a GL. This is critically important. Critically important, because what happens is after the fact, when you're audited, it's hard to download all this shit. Trust me, or people's bank. I just spoke to a guy yesterday. And by the way, this guy makes $1 million a year, so he's not a dumb fuck. He's a smart dude. But for whatever reason, his bank accounts got closed and he no longer has access to any data. It happens a lot. For bank statements, every time you make a deposit, make sure you save the deposit images. So the deposit slip, and everything that's deposited, you save all those deposits. That's one of the first things an auditor is going to look at. Because when you deposit things, it's possible you deposit income, or maybe it could be a loan from your mom. It could be from your dad. It could be from your buddy. Okay. In an IRS auditor's mind, anything that gets deposited is income. But we know that's not true, but you have to prove it. So again, and I would encourage all of you, spend the extra money to get a bank account where you can download the images on both. See, a lot of banks will allow you to download the check images, but not the deposit images. You need both. You need both. So again, for every bank statement, deposits, for all the check images, all the canceled checks, for all the wires, all that backup information, save it, okay? And then when you're doing your books, for every single entry, whether it's an invoice, and we're going to go more detail on this, whether it's an invoice or an expense, you're going to attach the underlying background information to that transaction. One step further, and I know this is so hard for so many of you, we need to tie your income and expenses to items on your calendar. So what the IRS rules are is that it has to be contemporaneous. What the hell does that mean, right? That's like an SAT word, right? Oh my God, back in the old days, right? I hated that stuff. Contemporaneous means that it happened in that moment. So like when you send an email, it's timestamped. When you send a text message, it's timestamped. A lot of what you're going to do financially may or may not be tax deductible based on the simple fact of whether you have a log. So for example, did you go to some vendor? Did you drive there? Did you not drive there? Really just put it in your calendar log. Like if you're having a lunch meeting, put the people you're having a lunch meeting with. Those are the things that when IRS audits, it's proof. So now what I want to do is kind of give you a format, like a mental framework to view all of this. So what I've done is I've combined the income statement and balance sheet as kind of this one unified statement, because I just visually, it's just more pleasing to the eye. So, and I call these quadrants. So quadrant 1 is income or sales, 2 is expenses, 3 is profit, 4 is assets, 5 is liabilities, 6 is net worth. And what I want to go through is what you need to do for each quadrant. Okay. So this would be your income. So like on your income statement, this would be all of your actual transactions. for every single item. And I know this is, by the way, the reason why the IRS wins is this is a pain in the butt. A lot of you entrepreneurs, and I know some of you on this call, you're visionary, you're ADD, you are not detailed oriented, and everything here is detailed oriented. So the people that are the most likely to get audited are the exact people prone to being audited because you don't do any of this shit because it's painful. And you don't have the funds a lot of you don't have the funds to hire someone to do it. So it's kind of this really bad cycle of shit. However, let's talk about what you should do. And if you were not willing to do it, I am willing to do it for money. And I've got Sarah, and I got Kelsey. We're willing to do this stuff for you. So let's talk about this. For every item of deposit, and let's assume that it's a sale, we want to have the sale invoice behind it. And if you're using a credit card processor, we're going to want that back end payment system information behind it. For every check you deposit and the deposit slip itself, download those images, okay? And in terms of what we're looking for, we want to review income for loans or APIC. So again, loans are not taxable. So if you get a loan from your mom or dad or a bank, when you receive money as a loan, it is not taxable. When you pay that loan off, it is not an expense. However, you have to prove it. Otherwise, an IRS agent will assume it's taxable. That is the default proposition. Another thing is if you have Zelle, PayPal, Square, any type of processing, is you want to save all of that data. Because what happens is you'll charge Bob $20,000 for something. It goes to the credit card. Depending on your processor, they may withhold the payment. They may not withhold the payment. I know, for example, Shopify will, let's say I got a client who has he does motorcycles. And for motorcycles, there's sales tax, there's shipping, and there's like other like weird fees that Shopify will collect it in total. But are you the owner like getting that money? But they see the gross, but they don't know that you have all these other expenses that will not show up on the bank statement. They only show up on the Shopify statement. So again, you really need to save all those backup statements because they do withhold information. Another thing that I see very common on the sales quadrant is sales tax that's included as gross. Remember, if you do that, you just have to back it out as an expense. Ideally, you'd have it on the liability balance sheet side. But for some of you that aren't as sophisticated, again, if you have it as income, make sure to back it out as expense. Another big thing that I noticed in terms of issues on the sales side is if you transfer money from account to account. So let's just say you've got money in one of your business accounts and you switch it to another business account. The IRS will see that transfer and they'll be like, oh, well, that's taxable income, even though you're transferring just account to account. Again, you must have all your accounts and be able to document it, which I know so much. I understand it's a lot. We've got so much to worry about. It's a lot. I get it. Okay, so now we're going to go into the expense category. And I got some pictures for everybody. So advertising, office expense, repairs, supplies, utilities. These are bank statement credit cards. Save those. If you have like an advertising agency, you'll probably have an engagement letter. You'll probably have a W-9. You might have 1099 these people. By the way, these are proofs. So yeah, let me be more clear. These are all items for proof for this quadrant. Okay. And then you'll have a bill. So yeah, just save all of this stuff. And then here's what I really recommend doing. A lot of us have work email. So I got Adam at adamlibin.com. What I highly suggest that all of you do is create something like receipts at adamlibin.com, or for Gary, it'd be, something gary.receipts@gmail.com, or whatever, how you want to do it. But anytime you get an invoice, you're going to forward it to that email account. So that way you have an email inbox just filled with invoices, and it's really easy to sort through. I find that to be very easy. Auto. Oh my God. When I was growing up, the Ferrari Testarossa, this was like my dream car. Gosh, that was a cool car. Okay. Auto, this is a huge expense for everybody. And it's one of the things that is so hard to prove in an audit. And I'll tell you why. You must keep track of all your expenses with all the receipts. Number one. Number two is you need to track your mileage in terms of on a per basis issue. So if you've got, like, if you go from point A to point B, from point A to point B, from point A to point B, you need to keep track of each one of those. It's damn near impossible. The IRS knows it. The IRS knows that it's very hard. So here's what I suggest that you guys do. Number one is, if you're going to go see a client, put it in your calendar. Put it in your calendar. And also, after you see a client, send them a thank you email, which I'm sure a lot of you would do anyway, because that's proof that you traveled someplace. Probably the easiest thing to do is with our modern, phones that we've got, like an iPhone with GPS tracking, is there's mileage apps. There's mileage apps, and just download one of those, and you click when you leave, you click, and you click, and it monitors and it keeps track of everything for you. Auto is probably one of the biggest expenses for business owners that the IRS can easily just deny, because unless you have all of this shit, deny. Very easy for an auditor. It's like, you don't have this, deny. They don't even, it's like, where's your log? I don't know. Fuck, denied. But then you're like, but Miss Auditor, I have all of these receipts for Chevron. I've got all these receipts for Costco gas. Costco gas doesn't sell anything but Costco gas. Anyway, it's very challenging. So a mileage tracker. Number two is, what I find easy on these is, when you do get credit card receipts, with your phone, take it, like you go to the gas station nozzle, press that button that says receipt, and then when you're it's printing out and you're still at the pump, take a picture of that receipt, then throw it away. Take a picture of the receipt and then email that receipt to your receipts email. And that way, that's a kind of a simple little hack, because that's where they get people. Oh, this is a really big one. Okay. Commissions, outside services, legal professional. Make sure to get contracts with all of your vendors, like even me. It's okay. I don't mind it. Or, we have our engagement letters. Make sure to get the invoice. Make sure to get the receipt of payment. And then also ask for a W-9 and 1099 these people. A sub issue here is, oh, dude, I don't want to cause it. I'm giving you stuff at a 10,000 foot view. We're not going to get into the weeds on any of this today. There's a huge movement. What is an employee? What is a contractor? What is outside services? What is an employee? Who's a commission person? Who's an employee? And sometimes the IRS auditor will be like, you pay this person every 2 weeks. Yes, sir. The amount's the same. Yes, sir. That seems like an employee to me. Do you set their schedule? And there's all these criteria. So what I find is that if you have a contract and it says like they're a contractor, again, the more stuff you have in your favor, again, IRS agents are like sharks. Sharks are very methodical, and they only go for easy kills. If they see a dying animal, they're going to kill it. Like, that's the way it works in the jungle. You're not going to, you're not going to fight a big beast that you could lose when you could, go after the little babies. It sounds so sad, but it's how it works. That's how they're going to treat you. So if you have all of this evidence, they'll be like, it's not worth going after you. The best audits are the ones where, and I've literally done this, where I bring in, I've literally brought suitcases of papers, and the auditor goes, shit. And they're like, all right. Then they'll look through it. They're like, okay, good enough. Good enough. So what I find is, the more you prepare on the front end, the less work it is on the actual audit. And because auditors have to make so much money per hour. Okay, insurance. You'll have a policy binder, insurance payment. I'm just going over the major expenses here. Interest. Make sure to have a promissory note with the payment schedule. If it's related to a house, trust deed, a credit card statement. Again, a lot of times what we do is we just lose shit. So, and I know a lot of you are so brilliant at what you do in terms of your profession, and you're not bookkeepers or accountants. And I would just highly suggest that you either get good at this or hire us. Those are your options, because that's what they're going to be looking for. Rent. They're going to want to see a rental agreement. They're going to want proof of payment, W-9, 1099. I'll give you an example. So when I pay my rent, it's to the same person. It's called PF Investments. It's like, well, I don't know if that's rent. Same amount all the time, but I don't get a receipt. So for example, there's certain things where you do not get a receipt. It's like, oh, thank you for paying your rent. You just take your money on a monthly basis. So that's when you would have your rental agreement say, here's my rental agreement, and here are the monthly charges that correspond. That's kind of how it works. Travel. This is a fucked category. Okay, let's talk. This is a big expense for most of you on this call. And it's really so the IRS has the easy rules and then the really super hard rules. Travel goes into the hard rules. And the reason why is, did you go to Hawaii so this is actually a true story. One of my clients, his name's Randy, great human being, and he sells furniture. And he literally, one of his, part of his territory includes Hawaii, Honolulu. So he goes there on a regular basis. And it's like, well, did you go to Hawaii for business or personal? Or what if you go there for business, but then you do some personal on the side? You know what I'm saying? That happens all the time. And so what the IRS is going to look for is the amount of time you spent, where you spent it. You really need to account for your time. And how do you do that? You know, through emails, talking with people. It's all this, not stuff that's necessarily financial, but back end. But you definitely want to keep a calendar, keep all your airline stuff, put in your calendar. I can't explain how important a calendar is. I know a lot of you, and I know this sounds so funny. Do not use, and I know it's so hard for us because we're so part of the computer age. Everything is in a is in an electronic calendar. If you have an electronic calendar, the IRS agent does not know whether or not you did that last night before the audit or when you did it contemporaneously during that time period. So again, that's why I like the thank you emails, because it's like, okay, well, here's the email, here's their business card. You know, if you guys have questions so if you guys have additional questions, and we'll get to the questions at the end of this, feel free to email me if you want to do a phone call. I do want to answer your questions because that's what I'm here for. Meals. Oh, here's another one where people just get fucked. Right. So for most of you, you'll have a lot of expenses in the meal category. And it's like the IRS knows this. It's like you went to McDonald's, you went to In-N-Out. Is that really a business meal? They're gonna, they just love this shit. They see this and they're like, oh, it's like salivating. You know, it's like a filet mignon when you I had this one auditor. We were literally going through crumpled McDonald's receipts. Anyway, meals are very easy to disallow because most people just don't have the proof. Again, that's why it's so important when you go to them. Oh, this is the trick for the meal. When you get the receipt, there's going to be a couple of receipts. There's going to be the credit card receipt that just has a dollar amount. You want the one with the number of guests and all the items that were ordered. You need that one. Sometimes they don't give it to you. And if the waitress doesn't give it to you, say, hey, I need this copy. Then what you're going to do is on the actual receipt, you're going to write who you were with and what you talked about. Who you are with and what you talked about. You'll take a little picture of that. You'll email it to yourself, throw it away, whatever. But the key thing is you're the elements that they need, that the IRS wants. They want a receipt with the amount of people that you're with. The reason why the receipt needs to have the amount of people is, are you with yourself or not? If there's 2 or more people, that's highly likely that have gone to lunch with somebody. And that's more easy to prove. And they're going to want to know who you're with, and they're going to know where you're at, but the receipt usually has the address, so what time. I mean, it's very intrusive in many ways. Again, it's not in line with human behavior to do all of this stuff. And the IRS knows it. That's why they're easy wins. The IRS is going to audit people for easy wins. And with these new auditors, they'll have the money to do it. Wages, this one's a little easier because most people, if you're doing this, you already have a lot of records. You'll have time cards, 941, 940, W2, W3. Assets. Okay. In an audit, they're going to say, tell me all of your assets, especially all of your, assets that do transactional accounts. And then if there's any assets that are depreciable, they're going to want to have your purchase, like whether it's a car, a boat, a plane. Anyway, so just to have that ready, because I know that's scary. And they're like, oh my God, they want to know everything. And the answer is yes, they do want to know everything, because the idea is that if you either forget to tell them, or you just don't know, or you're a dumbass, you're hiding it, you're underreporting your income. That's the presumption. So again, for bank statements, make sure you have all of your bank anything that's a bank account, have all those accounts, all of your assets, Just make sure that you have that asset list. For liabilities, these are going to be promissory notes, sales tax, payroll tax. Just make sure to have the underlying documents on this one. And this is a big one, equity items. A lot of you are business owners who sometimes or another, and I do this myself, where because there's so little separation between business and personal, where you have to put more money into your business account. And that's an APIC. So APIC stands for additional paid in capital. It's more of a corporate issue than an LLC. It'd be an additional capital. That's the idea. When you put more money into your business, the IRS doesn't know, is it income or are you personally putting in? So that's when you're going to have your personal account and show that this is not a loan, it's you're contributing. Distributions. This is a big one. They're going to look at your distributions and they're going to look at what you've taken out, and okay, they're going to look at all that. And then for stock, if you stole any stock. Here are other items of concern, and it's kind of beyond the scope just because we don't have so much time for today, but I definitely want to highlight these things just to bring them up because these are critical issues that I know they're going to go after. Real estate status. So that means, real estate professional status. There's a law that says that you cannot deduct passive activities unless you have so much more than 150 hours. I'm sorry. If you make over $150,000 of income, you cannot deduct the loss on your rental properties, but the real estate status allows you to do that. So they're auditing those. That's a target. So if your income is, let's say, $1 million and you've got rental losses of approximately 400,000, boom, very easy to go after this. Stock trader status, that allows you to write off stocks on a market-to-market basis. Not a huge audit risk, but be aware of it. Carry forward losses that are used. Okay, let's spend 1 minute here because I've got a client who's going through this. Really sweet guy. Actually, this person actually might be on here. I know I saw them pop up earlier. Let's say that you lost, and I won't use the exact person for this, their dollar amounts, but we're talking millions of dollars. So let's just say they lost $10 million in the stock market 10 years ago. And in this year, they've got a crypto gain of 7 million. They can use that carry forward loss from prior years to offset their crypto gain this year, right? Everyone's like, yay. However, the IRS knows, so here's the rule. If you're carrying forward a loss and you offset some current year income, the IRS can audit the underlying loss 10 years ago. Now, what are the odds that most of you have kept your stock loss records from 10 years ago? Low. So this has to do with any type of loss, whether it's a passive loss on a rental property. See, that's where they get a lot of rental property owners. See, many of you, because you make over 150,000, you have a passive loss that doesn't get used until much later on. And then you do, and then they audit you. They're like, oh, well, we need to track your losses from inception. And they'll be like, okay, let me see your financial record. Now, most of you are aware that you need to keep your records for 7 years. 3 to 7 years is, the idea, which is true. However, if you have a carry forward loss, again, you must have records from that initial inception period. Same thing like when you're selling a house. And oh my gosh, just dealt with this. Person has a house in Santa Monica that they're selling for like 7-ish million. They bought it for like 100 grand, but they've done all of these improvements. So this is like a grandma type family. They're in their 80s. Good for them, right? Huge profit, but over the years, they put in new roofs, they put in a new kitchen, they put in all these new things. But have they kept those records? No, maybe not. Of course they have. Okay, here's another big issue I want to talk about. Again, we don't have enough time to go into it, but I want you to be aware of it, that the IRS is focusing on the issues. If you have an S Corp or a C Corp, there's something called reasonable compensation. Most people have zero. So if they're doing an audit search, they'll put S Corps, gross revenue over, let's say, 200,000, and wages and salaries to officer equals 0. They'll print out a list and boom, those are all easy targets. And then it sucks for them. There's something called passive versus active income. That's a complicated subject. We'll go into it, but just be aware that's an issue. Cryptocurrency with a typo. That's a huge new issue. I've currently got a client who is being audited on this exact issue for about $4 million. And the problem with crypto is, and some of this is old stuff, is that the records are so shitty, and everyone's like, well, it's shitty. And then the taxpayer's like, well, my provider doesn't give me anything. And the IRS is like, I don't care. So that's what we're arguing right now. Here's another one that'll affect all of you who have older parents, and you're going to be, especially older parents with rental property, maybe like commercial property. When you inherit property, and make sure you inherit it and it's not gifted prior to death, you get what's called a step up in basis. And you need to get a valuation. So there's going to be a lot of valuation work out there. So just be aware of the valuation work. Selling your personal home, just make sure to keep all of your stuff. So now at this time, these are our services we offer. So some of you are like, man, I might have some exposure here. I'll be happy to take a look at it for you. Whether it's bookkeeping, I just think probably the most important thing is are your books in order, and do you have the proof behind it? Those are kind of the issues. I'll be sending all of you a link. Oh, for all of you right now, if you could send an email to help@adamlibman.com, that goes straight to Kelsey, help@adamlibman.com, and just say you're on the Zoom session, and we'll email you a copy of all the slides. And then also, if you're on this call, free 15-minute call, but you have to be on the call to make it happen. We're offering that to answer any of your specific questions. That being said, and I'm going to try and bring Kelsey here. If there's questions, I can answer right now. So I'm going to try to go. I guess there should be a chat function here. If any of you have questions, type in the chat box, and I will answer your questions. Otherwise, what you can do is just send an email to help@adamlibman.com, or click that, and I'll send you a copy of that square link. Or you guys can see my messages. I'll just say hi from Adam. I don't know if I set it up to even do. Oh, yes, we can see it. Oh, here's a question. What if we have a C Corp and an LLC? If one gets audited, should we expect all to be audited, Teresa? Yes, the answer is yes. Oh my God, this actually happened to me. Yes, the answer is yes. Because what'll happen is, well, not necessarily, but probably. Probably is, so what they'll do is they'll go to one of your businesses. If you have a lot of intermingled accounts and you have a lot of loans to and loans from, that is highly likely. If your paperwork is in good order, so auditors, their first thing is does this person have their shit together? If you have your shit together, the odds are lower. If you have a lot of intercompany, so let's just say that one company does business with another company, then the answer is highly likely yes, because then there's a lot of issues of, is it the right price, and why are you doing it, and is it legitimate?
Well, our LLC, hi, Adam.
Oh, hi.
Good to see you. Hey, our LLC owns the property that our C Corp rents from.
Oh,
but
gotcha.
Everything is legit, and there's a check going back and forth, and we have a CPA to.
Yeah, that's a great question. Yeah. When you have just so let me repeat this, just make sure I got it right. Is when you're C Corp, like you own your property. Your property is in an LLC, and you pay the C Corp pays money to the LLC for rent, right?
Correct.
That's actually very common. It's going to have to do with, is it way under market or way over market? So the issue there is going to be what's fair market value, and in some cases, you might have depreciation on your LLC side. So in some cases, some people overdo their rent, or they make it really expensive when it shouldn't be so expensive. So if it's a fair market, okay, if it's
like $1.25 a square foot, so that's pretty normal.
Yeah, if you're in the normal dollar per square foot rate, very low, especially for that issue, very low. Very low.
Thanks, Adam. Good to see you. Thanks.
Yeah, you too. Yeah, you too. Hey, Adam. So if we make under 4, you may not be the target. Oh, I'm actually suggesting that if you're a business owner, and if you have an LLC, S Corp, or C Corp, and you've got revenue over 400, 500, 600,000, but your net income is very low, I think you will be a target. Because I think the IRS is going to say as well, is this person manipulating their income to appear below the threshold? I think so. But again, we're not going to know the fruit of this labor until 3 years from today. So, and by the way, is Joe Biden still the president? What happens if Trump gets in office and wins? There's a lot of uncertainty politically because will Yellen still be in office? And just to give you a little background, the current person is the IRS commissioner today, used to be one of the top private practice people for rich people. So it's a very interesting. Oh, do you have a show safe percentages? Oh, I do not. Oh yeah, good question. Back to you, Teresa. So there's two philosophies. One is, what if I claim expenses lower than the audit range thresholds? I do not take that approach. I say whatever is true, because then some clients are like, Adam, just give me a return based upon what's safe numbers. But that goes to, are you making shit up? And the penalty for making stuff up is very bad. So do I have those numbers? Do I know them? Intuitively, I do know, but I do not share that because I don't want to be known as the guy who tells people safe numbers. It scares me. Can you explain again what Janet Yellen's position is? Yeah, so going back. So when they did this act, let me go to her statement. She wrote a letter to the IRS person, and it's basically these are the qualifiers of who we're going to go after. This is her, and by the way, yes, do an email, help@adamlibben.com, and below there I got the actual link to the letter itself, and you can kind of read that there. But again, like, look, Joe, a month ago I thought Joe Biden was dead politically. He's had some good wins. Trump has had some losses this week. Who knows who's going to be the president in 2 years? Remember, it's going to take 2 to 3 years for all of this to come to fruition. And depending upon how they implement this stuff. See, this is we're living in fear today because we have uncertainty. In 2 to 3 years, we'll know how they're going to actually implement this. Any other questions? Please. Hi, Adam. I've been providing you my crypto craze with crypto tax. Oh, yeah, let me read this to you. Oh, I think this is Jason Chang. I know her. Hey, Jason. Hi, Adam. I've been providing you my cryptocurrency trades with crypto tax program that helps me generate tax reports. I have logged every single transaction on over a dozen of exchanges to have a clear picture of all my trades and an audit of a risk. I have the tax report. Oh, I want to differentiate between two things. Are you at risk and can you win? Are you at risk and can you win? And the analogy that I give to this is, if you're driving on the main boulevard in your town on New Year's Eve, you're probably going to encounter a DUI checkpoint. But most of us aren't afraid because we haven't been drinking. So what I want to encourage everyone, don't be afraid of being audited. Be afraid of, can you win? So in terms of Jason's question, he's good. That doesn't mean he's not at risk, especially if you have losses or gains. And so when you put in your dispositions, you're going to put your vendor. So it's Robinhood Securities, Robinhood Crypto. I have a feeling they're probably just going to do some random audit checks to see how well people are doing their stuff. I know for a fact, Jason, you're on a different level, but I know that most people have very poor records and it's an easy win. And every time you do a trade or move from wallet to wallet, it's considered a trade. So you can have a very high gross income, but with very little profit. And it's very easy for the IRS to go after you and deny everything. So yes, you are at a higher risk, but I think you will be okay. You will be okay. Any other questions? Some people actually pay me for my time. I don't know. So now I'm doing it for free. So that's a pretty good deal. Any other questions? And if not, I know some of you are like, well, shit, I don't want to spill my shit on Zoom and have it shared with the world. So I get it. So if you're in that situation, I appreciate that. Did you say it's best to keep a physical calendar? Teresa, yes. My dad used to buy just tons of calendars and give them to clients just so that way. Yes, keep an actual physical calendar, because then it's, when you have a physical calendar, first off, the auditors will be shocked. Number two is based on the ink and that it fades over time, and like what they look for is different inks, different pens. Is it faded? Are you using the same pen? Use different pens. Don't use the same pen every day. Use different pens, ballpoint pens, different color pens, because it shows that it's being done over time. Yes, do a physical one. Because again, that's greater proof. So there's like different levels of proof, and that's considered a very high level of proof. It's hard to fake like that, if that makes sense. Very hard to fake it. Anything else? Anything else? Again, if not, just go to help@adamlipman.com. And then for anyone on the call, we'll be doing a free 15 minutes for your questions and issues. And again, we can't, it's like, for example, we can't stop bad things from happening to us, but we can be mentally prepared for how we rebound. And I think that's what an audit is like. It is a shitty process to go through emotionally. It does feel like you're being interrogated, because you are. It is scary. It's scary. There's no way around it. Perfect. Well, thank you all, everyone. I really appreciate your time today. I really appreciate everyone coming on here. Really, I'll try to do more of these in the future. And yes, there will be a Zoom, and I'll send it out to everyone. But yeah, I'll try to do more of these as long as there's demand. I don't mind it. I mean, this presentation actually took me probably like 25 hours. Like, oh, that's a lot of time, but I feel like that we can repurpose this. So, all right, everybody, have a great day. And I think that's it for me. I'm going to close out the meeting again. If you have email Kelsey at adamlipman.com, and we'll go from there. Have a good one, everybody.